Probably one of the most frequently used indicators in technical analysis is the simple moving average. The concept of moving average is it shows you the value or the average value of a pair's closing price over a certain amount of time. In this particular case, we have a daily chart and we are looking at a 100 moving average. So what this means is it takes the average price over the last 100 days and plots it on a chart. This is significant because they can be used to spot momentum, trends, and potential support and resistance. As you can see by this chart, certainly the trend has been down for quite some time in the dollar Swiss daily. You can see the price rose up to the 100 moving average and consequently was rejected each time it got there. There are different ways to use the moving average, and sometimes traders will actually insert a second one to identify quicker momentum shifts. So in this example, I'll put the 25-day moving average on, and as you can see, back in this particular time frame, back in July of 2007 or 2010, excuse me, the red, the 25-day moving average, plunged below the 100-day moving average, signaling that the short-term momentum was declining rapidly, and eventually the long-term momentum agreed with it, and both were heading in a downward direction. Using a moving average crossover system on that entry in July of 2010, you would have yet to get out of this trade. Almost an entire year later. As you can see, once the momentum picks up, these two will spread apart, and that shows that the momentum is definitely gaining in strength. Moving averages can be used this way, and is quite often used this way by long-term trend traders. As you can see, the shorter moving average tends to get chopped up a little bit if you were to just use it on its own. As you can see, the price goes in and out of the 25, above and below it pretty quick. But the 100, on the other hand, takes much more information into account, and therefore takes a lot more to be broken, much less crossed over. There are different moving averages that you can use. These are the simple moving averages, which is just the simple mathematical formula of a X amount of periods added together divided by the periods that you're using, for example 100 or 25. But there are also exponential moving averages, which are just as common to see, and they give, through a fairly complex mathematical formula, a little bit more weight to the more recent candles. So for example, the 100 moving average might place a little bit more weight on the last 20 candles, as it shows it to be a little bit more sensitive to the recent price fluctuations. It should be stated that the exponential moving average would be preferred in the shorter time frames, perhaps maybe on the 15 or 30-minute charts if you're so inclined to trade the short term, than the larger time frames. In a larger time frame setting, such as a daily or even weekly, choice between simple moving average and exponential moving average really is going to be negligible on the performance of the trading system.